Well, China saw both consumer and producer prices fall in July. It's the latest red flag as the world's second largest economy struggles against slumping domestic demand. Could cheaper China prices help the U.S. and other world economies in their fight against inflation? Or is China's deflation in for a reversal in the months ahead? With more, we're joined now by Ben Emons, who is head of fixed income and macro and senior portfolio manager at NewEdge Wealth. This is something I have been struggling to understand, Ben, in full transparency. You know, how much should we weight the deflation that is happening in China?
If you go pre-crisis or even pre-financial crisis, it mattered a lot because China was producing all these really cheap goods that we imported, and that put pressure on our wholesale prices and consumer prices. But that's somewhat reversed now, even pre-pandemic, but mostly after the pandemic. So we've shifted away the supply chain to an extent. We're importing, but not as much anymore than we used to. And so this deflation that you're seeing today, really driven by pork prices and transportation costs, that's most of it, is just very domestically generated. And I drilled in the pork price dynamic of China this morning, and I noted that actually the government is taking some action there to try to tighten up pork supplies. So I think this deflation that you're seeing in CPI is probably mild, may stay, somewhat there, but reverse. And I think therefore the impact that it will have on other economies is limited.
Yeah, we're showing your pork price chart right there. I just had to highlight it because I love that one. I think it's very interesting what you're talking about with them trying to bring those prices down.
Yeah, and we saw it in your note this morning too, even as you were laying it out there a moment ago. You also noted as well that there's a second batch of Central Pork reserve collections to stabilize prices that's coming about. But you also mentioned in the note that the entire world doesn't revolve around Chinese pork purchases. So where else should we be keeping a close eye on, especially within the second largest economy right now, to really monitor where those signs of weakness are persisting, or where, on the other side, for companies that are looking for any kind of sign of strength within that economy, where would you be keeping an eye on?
Yeah, you look first at foreign direct investments, because that's, I think, key. So China has been really opening that gateway up again. But we know how they operate, right? They don't let everything come in at the same time, and they restrain capital to an extent for being, exported out again once you have invested there. But I think that's a key part, because you get the opportunity to invest in China. It is the biggest consumer market. So as much as the pandemic as an afterfact, which is a study out that there's long COVID in China that's actually depressing to an extent consumer demand. At the end of the day, I think a lot of U.S. and other companies will be willing to expand their operations there if they are allowed to. Now, we do know from the administration the other day, they put it specifically on semiconductors, a new policy out that they want to restrain that. But I think if you otherwise think of Tesla or Apple or any of the GEs, other companies, China opening up its borders, that's the big deal. I think that's what we want to watch.
Yeah, and there's some reporting this morning, some new reporting that there could be a curb from the U.S. on certain types of venture capital and private equity investments in China as well. So I am curious, yes, there's a lot of U.S. companies who do a lot of business in China. But by and large, the U.S. equity market writ large seems less concerned about the China slowdown overall. Is that the correct reaction? Is that are U.S. investors sort of paying less attention to China at their peril?
So we came into the year, there was a lot of hope about this is the China reopening, so it's going to have a big macro story. In my view, it's still there. Like it's actually just slower reopening, slower effect. And that's maybe where the decoupling has taken place over the last number of months as the AI narrative really hyped up in markets. And people don't look at China so much in that AI context just yet, even though they're a huge competitor, as we know, which is more focused here on domestic companies repositioning itself for the AI hype and is spending there. And our domestic economy is just being thriving on that. We had a moderation of, to some extent, inflation that's boosted real incomes. So I think that is really where that decoupling between US markets and China markets is for now. So that leads you to the point of that. Let's say this reopening actually becomes a bit more surprising in the second half or the first quarter of next year. I think that we can conclude that China reopening last year in the fall is starting. that probably has affected Europe and the US economy staying out of this presumptive recession. Because let's face it, the trade between US and China is huge, as well as Europe. I think that has kept the situation sort of together. But the financial markets have judged like, well, this is a slow motion process, so let's focus on other things. I think that's why you see the decoupling.
So in other words, sorry, just to follow on that, so you think that when we do get more to the conclusion of that reopening process, it could provide some further upside?
I think it is. And I think that, as I said, like the reopening one hand of foreign direct investment into China, that would affect the stock market here, obviously, because we know this is a huge area where you can generate significant sales. Simple statistic I know from Apple is that I think they generate over 300 billion in sales in China. So if that can boost that, which the sales numbers have been sagging, now there would be an impact on our markets, right, given Apple's weight in the market. On the other hand, it's also about China's own reopening in terms of outward, like as in they have looked at investments outward. There was a policy statement out the other day of trying to put more money into outward investments, which I think means investing in other real estate or property or companies. On the other hand, there's also this tourism wave. That's sort of my own personal view. It's interesting how Vietnam has had a record inflow of Chinese tourism just coming through now. That's the latest statistic. We haven't seen China tourism pick up so much just yet. I think that's another sort of, let's say, reopening tail that we're going to deal with coming from China.
And so we've been in such a kind of de-globalized environment for the past few years now, as we think about the ties and some of those severed ties between U.S. and China on the trade front, that has caused officials to have to come back to the table and try to get new deals done. But in the interim period, now you've got the reopening. Can a reopening in China drive re-globalization in the next year, 2 years? And what does that look like for people who are waking up this morning hearing us talk about this in the A block of this show and trying to figure out what that means for their portfolio?
Yeah, and the re-globalization would be fantastic, but I think it's a bit of a difficult reality, because just listen to the rhetoric coming out of the campaigns now. Former President Trump wants to raise even more tariffs on China if he gets into office, as one example. And the current administration has maintained his policy. That's been actually very much of a pillar of the quote-unquote decoupling or decoupling of between US and China in terms of trade. And that is actually, I think, a key, let's say, geopolitical or political policy towards, in order to see this re-globalization really take place. On the other hand, look, trade is trade, so companies want to trade with China. And as long as there's not as much as restriction on that, then it will flow as China tries to further reopen its economy. So I think you'll see some effect coming through in a number of quarters from an improvement of trade between China, US, and Europe, just from a flow perspective. But long term, if these tariffs stay in place or it becomes even more political as we're hearing, then I'm not sure if the re-globalization is so easy to achieve.